We're going to stay on the markets, which have had really little conviction, rising and falling on headlines over Russia-Ukraine tensions and mixed signals. Here's what President Biden had to say just a short time ago about an escalation. Take a listen.
Mr. President, how high is the threat of a Russian invasion right now?
It's very high.
Why?
It's very high because they have not moved any of their troops out. They've moved more troops in.
Is your sense that this is going to happen now?
Yes. My sense this will happen within the next several days.
And of course, Russia denying flat out that its plans to attack. Okay, for more, let's bring in our market guest, Jim Worden, Chief Investment Officer, Wealth Consulting Group. Jim, thanks so much for being here. Just your reaction. I mean, nobody really knows what's going on. It's a question of he said, she said. But what is the reaction, market sentiment? And then what do you think it does, more importantly, to Fed policy come the March meeting?
It's a good question. So there's a lot of factors that are affecting volatility right now. I think right now, number one is Russia, Ukraine. Certainly, this isn't a major issue when it comes to GDP growth and earnings growth for most companies, but it does something, I think, to investors in terms of their sentiment and investor psychology. So I think that this is something that we're going to continue to monitor. But, also earnings are slowing in some cases. And in some cases, the reports have been great reports, but the outlooks have not been that great. And we've seen some of these companies pull back because of that.
Yeah, and Jim, I want to talk about earnings more in just a minute. But first, just want to get your, before this geopolitical tensions, we were firmly looking at, inflation and Fed policy. So I'm wondering, after that CPI number that we got and then PPI, 9.7% gain year over year, has inflation, in your opinion, peaked? When does it start to moderate? And where does it end the year, vis-a-vis what the Fed's target is?
Yeah, as it relates to Fed policy, I believe that the Fed is actually, the markets are pricing in a more hawkish Fed than what we'll see. The yield curve has flattened dramatically when we look at 2s and 10s. This is not a great sign as it relates to future growth. We still believe we're going to see mid to high single digit growth in equities this year. But I think a positive would be if we can bring inflation down to 4 by the end of the year. Now, what the Fed is doing, that's going to help quite a bit in terms of raising short-term interest rates off of 0. But there's some natural things that can help reduce the inflationary pressures. The supply chain issues, as they moderate, as they get back to normal, as COVID, hopefully we don't get another strain here, knock on wood, but as that does kind of get removed from the picture, that will alleviate some of the pressures. One of the challenges is we have a lot of consumers that are flush with cash, and as we see with the Walmart report, they're still spending. But as oil prices continue to stay high, as other commodity prices are high, eventually we do believe we're going to see inflation come down.
So let's talk a little bit more about earnings. As you said, Walmart basically hit it out of the park. Nvidia, in my opinion, had a really strong quarter. Demand is strong. Their outlook was good, but yet investors are punishing them. Are we expecting too much? Or is this more about a margin story?
Yeah, I think it could be more the latter. There's a lot of speculative money that has gone into the markets over the last couple years. I don't think we're in this moment. This is not a back up the truck on stocks moment. But when you do look at companies like Nvidia and AMD and Intel that are down, in some cases 30, 40% or more, I think selectively you can look at these companies and say, hey, these companies will be around here in 5 to 10 years. They have good, solid growth. And so for some of those companies, I think it makes sense to have exposure if you don't already. Some of the other names that have just gotten too rich in valuation, they're being repriced along with this higher inflation and higher anticipation of rates.
And Jim, I want to ask you about hotels. They've been reporting this week, and some hits and misses. So Hyatt and Hilton having some issues, but saying RevPAR is up. Marriott saying they're seeing growth in both business and leisure travel, but they're still about 12% down from pre-pandemic levels. So is this a sector that you advise staying away from right now, or is it a good time to jump in and get some deals?
Yeah, I think it comes down to price, and we like growth, but we want it to be quality growth. We want it to be at the right price. To the extent that we're seeing consumers move away from the economic activity by consumers move away from products and more into services. Services was the area that got hit the most during this pandemic, and it's still ongoing. But things are getting better. I'm optimistic that we're going to see more travel. We're going to see more, staying in hotels and things like that. When people feel comfortable, that will increase. It just takes time to get back to where they were prior to the pandemic.
And then, Jim, a lot of liquidity has left the markets, but I want to get your thoughts on allocation, particularly cyclicals and energy.
Yeah, so we continue to like energy. We like industrials. We like financials. If we have a situation where growth becomes a challenge and this yield curve is getting flatter and flatter, and there's a potential that it inverts, we will continue to monitor that very, very closely. But to the extent that this is more short term and we do see more of a shift higher and longer term rates, yeah, these are still areas that we like. The thing with energy is, this is probably not going to be a longer term trade, just because we're going to see more production come online. Consumers are going to start feeling it more when they go to the pump. And so that may not be like a long-term trade, but we still like it. We're still overweight. And it's certainly helped from a diversification standpoint when other names, like information technology have gone down. Energy has certainly helped.
All right, Jim, tons more questions for you, but we're out of time. We'll have to leave it there and hope to see you back again. Jim Worden, Chief Investment Officer, Wealth Consulting Group. Thanks so much for your perspective today.